Sudarshan, thank you so much for that. But let's cut across to my colleague Mangalam and Shilpa, who are in conversation with Rohit Jawa, CEO and Managing Director of HUL.
Purity. During the year, we continued on our journey of sharply executing the Aspire strategy to unlock a billion aspirations. We have segmented our portfolio into core, future core, and market makers. Our segmented portfolio approach facilitates better allocation of resources to maximize overall organizational growth. In financial year 25, we continue to modernize our core portfolio with relaunch of Lifebuoy and Glow & Lovely, strengthened our market position in future core, and delivered double-digit growth in market makers portfolio. Our focus on transforming our business into high-growth spaces has led to a 200 bps shift from core to future core and market makers. We have accelerated our pace of transformation with sharper where-to-play choices. We acquired a majority stake in Oziva, a health and well-being business, in January 23. The business has since scaled up from an annual run rate of 100 crores to 400 crores. Last quarter, we announced the acquisition of 90.5% stake in Minimalist. I am pleased to inform you that we have completed the closing formalities as of 21st of April 25. We look forward to unlock the next phase of growth with Minimalist, which is now a part of larger HUL ecosystem. Period business divestment was completed, unlocking value of circa 600 crores. The demerger of ice cream business is progressing on track with regulatory requirements, and we expect it to be completed by end of financial year 26. In line with our strategy to strengthen business resilience, we announced the acquisition of palm undertaking from Vishwatej Oil Private Industries and announced our investment in Lucro Plastic E-Cycle Private Limited. The former will aid our palm localization strategy, while the latter is a step towards developing flexible plastics circularity. Considering our performance for the year, the Board of Directors have proposed a final dividend of Rs 24 per share, subject to approvals of shareholders at the AGM. Together with interim dividend of Rs 19 per share and special dividend of Rs 10 per share that we announced in October 24, the total dividend payout for this year will be 12,453 crores. Moving on to March quarter 25 results. Underlying sales growth was 3% and with an underlying volume growth of 2%. Gross margin at 49.8% was lower by 160 bps year on year. This contraction in gross margin was driven by commodity inflation across palm oil, tea and coffee that wasn't fully priced for. EBITDA margin remained healthy at 23.1%, lower by 30 bps year on year. Profit after tax before exceptional items and profit after tax both grew at 4%, including the benefit of interest income on prior period tax adjustment. Coming to performance across the four business segments, Home Care delivered a robust mid-single-digit UVG, which translated to 3% USG as we continue to pass on the benefits of deflationary commodity prices to our consumers. Beauty and Wellbeing grew at 3% USG, led by volume. While Hair Care delivered double-digit growth, Skin Care was impacted by mass skin performance. Personal Care delivered 3% price-led growth, while UVG declined in low single-digit. Skin Cleansing, led by non-hygiene segment, continued its positive growth momentum. Oral Care delivered price-led growth. Foods turnover declined by 1% on the back of mid-single-digit decline in volume. Robust performance in beverage, ice cream and packaged food was impacted by performance in nutrition drinks. Margins in all four segments remain healthy, with Home Care at 18%, Beauty and Wellbeing at 33%, Personal Care at 18%, and Foods at 16%. Moving to our near to mid-term outlook, we expect growth to gradually improve as a result of our accelerated portfolio transformation actions and improving underlying macro conditions. We anticipate first half of financial year 26 to be better than second half of financial year 25. If commodities remain where they are, we expect price growth to be in low single digit. Gross margin is expected to further moderate due to commodity inflation and our continued commitment to provide consumers with right price-value equation. We will step up investments behind our multi-year market-making platforms, channels of the future, and strategic capabilities to successfully land our portfolio transformation. As a result, EBITDA margin will be maintained in the range of 22 to 23%. We believe this is the right time to accelerate investments as we chart the future course of growth for the company in the backdrop of portfolio transformation actions and improving macro environment. With this, we conclude our prepared remarks and I will take questions.
Hi, thank you so much, Andrew. If I could just quickly touch upon the urban demand scenario. Can you give us a little more clarity on how the improvement's been there? Are you seeing any rebound in the urban growth and also a little bit of the rural demand also? Give us a little more sense on the inflationary scenario also. You said low single-digit price growth is what you're expecting. Going forward also then, how do you see the volume to price mix also changing for the fiscal that we're entering into? And then on the same lines, then how do we look at the margin profile as well?
So maybe I can cover off the broad market shapes and then Ritesh can talk through some of the more nuanced points you asked about the price and mix. So broadly speaking, we've seen market growth subduing over the last few quarters, largely led by urban. Rural, on the other hand, is resilient and robust, and we see that holding up. And we do expect going forwards, macro triggers are positive. We see, of course, the food inflation coming down sharply. We see the interest rates also being reduced. That will impact the EMIs and therefore lots of urban households. The crude oil being softer also does impact the entire economy. The agricultural output is strong. The monsoons have been good after a long period of difficult weather conditions. The reservoirs are full, the granaries are full. We believe that the rural areas would remain robust. We as a company, of course, have or will compete in all market conditions, but we do expect that the macro drivers are positive going forwards, and we expect the urban demand therefore to start, inching back up. Therefore, on the whole, we do see gradual improvement in the macro. Importantly, for our own business, we are very committed. We have been, going where the growth is, despite what the market conditions were in the last few years, and we've been strengthening our portfolio, moving it to faster growth spaces, getting channels of the future, building capabilities, innovating quite intensely, acquiring brands, launching brands. So we feel quite confident at this point that we have a strong investable portfolio. We are operationally quite robust. Our brand powers are strong, getting stronger. Our penetration growths are good. So we expect that as tailwinds come in, we are the best prepared for this turn. And therefore, we feel confident at this point to lean in and invest for the future. There'd be categories that are price sensitive, where there's high level of competitive intensity. We are going to unblinkingly defend those categories. We're also going to make sure that our price value equation is absolutely on dot. That gives us the best chance to actually improve our competitiveness further. So we are being quite active and I would say leaning in aggressively on investing on our business. We believe this is the good time to do that, and it's a very opportune time to invest for the future of the FMCG in this country, which, as you know, is a long game, is a great place to be in.
Right.
So let me just add and pick up the other questions you had. So as Rohit mentioned, both we look at external atmosphere of macro conditions and what we have done internally to drive our portfolio transformation. Put together, there's a pretty strong case for us to further dial up investments going forward. Coming to pricing, there are two different group of commodities. When I look at crude oil and related commodities, which impacts by and large home care, we are seeing deflationary scenario there. In fact, crude oil back to back for the last 2 years has been deflationary. But we see a group of commodities like palm oil and tea where we have seen inflation. And hence, there are reasons where certain categories will see price increase, certain categories we will have some price decrease. On a net basis, we expect low single-digit price range going forward. To your question, where do you see the balance between volume growth and price growth going forward? It's a healthy mix as we speak this point in time, but as the year will progress, if commodities remain where they are, volume growth will be ahead of price growth.
Right. But which are these categories, Ritesh, if you could say, where we can expect price decreases and where can we expect the price increases?
Yeah, so home care is a category which gets largely impacted because of the crude oil. This is where, as we speak, in the quarter, we had a negative price, and this is where the momentum of pricing will be negative, unless, again, the signals of commodities end up changing. And price increase will be essentially in skin cleansing, which is where crude palm oil has increased, and tea category. Of course, tea, I'm very mindful. We are now not in season for tea production. The new crop will come in May and June, and we'll have a different signal, if at all, and we'll determine basis that what happens later on in time.
Right. If you could also just touch upon the margins bit that I was talking about, how do we look at the margin?
So margins, what we had explained that we are now investing behind more, given both the right time to invest because of internal dialing up of the portfolio and because of external improving conditions. Because of that increased investment, we will go to a little lower EBITDA range of 22 to 23%. This guidance is for next few quarters for us. Right. Now, of course, few quarters later, we'll determine into what guidance we end up operating at, looking into market conditions. as Rohit mentioned, we always maintain between growth and profit, it's unblinking growth as a priority for us. And we have very strong levers to manage margins. This is more investment-focused decision where the margins will be a little lower compared to where we are today. Our machinery, our reflex muscles on driving savings across all lines of the P&L, that remains very strongly installed. And that will keep helping us to keep driving more amount of investments across the board.
Just to confirm on that, last time the guidance was between 23 to 24% of margin. So right now the guidance is 22 to 23% and on the lower end of that band. Is that correct?
So let me clarify. Last time we had spoken about a guidance of 22 to 23, and we said we'll be the lower end of that range. So more towards 23 is what our last guidance was.
Okay.
Today, what we're speaking about, that we are lowering that number to a range of 22 to 23, because we believe now is the right time for us to dial up further investment to drive growth.
Okay. And in terms of one more thing, there's a trend that I observed yesterday in one of your peers that came out with the numbers. They said that they've seen more traction in the lower end of products, and of course the small packaging trend has always been there. But something that came out in their commentary was that there was more traction seen in lower end of products as compared to premium products. Is that something that you have also observed?
So, first of all, we speak from what we see in our own business, and I just restrict my commentary to that. We have seen premiumization, as I mentioned to you, and we must always keep our lens a bit wide. Zoom out, first of all, then zoom in. On zooming out, this is a market that premiumizes. In the long term, people are upgrading. They quality of life, they want better products, and I'm not talking of extremely privileged or luxury products, but people climb up to a better quality of product experience at every level. That trend is secular. We do see that trend continuing this quarter and last quarter, although it's compressed a little bit. So instead of premium going much faster, it's sort of come down a little bit, but it's still faster. So there is a general upgradation trend, although it's muted compared to the past few quarters. We must not make too much of it and stick focused on the long term, because eventually the market has upgraded, we upgrade. We are a very, very low per capita consumption market at this point.
Right.
So that's number one. On the pack sizing, the large packs still are growing a little bit ahead. There is a trend towards downsizing. People are probably managing their budgets. Of course, as rural is growing now in the last few quarters ahead of urban, and rural consumption generally tends to be on the low pack sizes, that also weighted average makes an impact. So there are these twists and turns, but I would not overly focus on them. I think the market in all categories is at a very low per capita consumption, and market development is the main thesis for growth. Innovation, improving quality of our products, getting people to use something more better is the main thesis of growth in this market, and we stick to that in medium and the short term.
Any guidance with respect to growth where Minimalist is concerned, because beauty and personal care has done very well this quarter? What are the kind of targets that you are looking at right now?
See, we had mentioned as we acquired the business now, we completed the whole transaction 21st of April. We are very focused to unlock both growth synergies and cost synergies. Leveraging the R&D entire process and capability that we have as Hindustan Unilever, we will benefit the business of Minimalist with that. Our supply chain network of production capacities and our expertise in that space will end up giving synergies to Minimalist business. We will also aid international expansion of the business. And last but not least, Minimalist is by and large an online brand, and we'll end up leveraging the offline distribution. So these are the four elements of synergies with which we will now start running the business. We'll keep you updated in times to come how those synergies are going to look like. But we are very optimistic. It's a fabulous brand, very well positioned in the masstige skincare category, and we do believe now within the family of Hindustan Unilever, it will have a very bright future.